Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hanf and Nam Phan of Pacific Private Money. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. That certificate is not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. And now that COVID is starting to let's put it this way, things are opening up a little bit. You should be able to use those tanning certificates pretty soon. And today's trivia theme for us old-timers is the movie Jaws. Remember that, 1975? That'll be kind of fun, see how much you know about Jaws. All right, our special guest today is Evan Palmer, welcoming him back of Bay Credit Restore to discuss credit repair. Evan, welcome back to the Best of Investing.
Thanks so much.
Yeah, now, since we're trying to remember, we had you on probably like January of earlier this year. What has changed in credit? Because with COVID and all that, you had these deferments, and
right.
We talked about this before on the show when you weren't here about how deferments, they kind of show up, but they kind of don't on your credit reports. So why don't you go into that?
Yeah, the CARES Act, the big $2 trillion stimulus package that was passed after the lockdown happened, inserted a little bit of language into the Fair Credit Reporting Act. And really the word of the day was accommodations. Okay. And accommodations could be, and I just don't want to leave anything out, an accommodation could be a forbearance, a deferral, a loan modification, a skip a payment, a pause, some kind of deal that a borrower could work out with a lender. And inserting that into the Fair Credit Reporting Act allowed for some consumer protections when it came to reporting, so that if a person worked out a deal with their lender that they could miss some payments, it wasn't going to show up as late payments on credit reports. Of course, anything that is out of the ordinary for a lender reporting to a credit bureau, sometimes things don't go as planned, and there were some mistakes with some lenders, even in following those directions. But that was the big thing that we saw. And so actually, I mean, when you think about how many people were at that point where they wanted to or felt they needed to ask the lender for some kind of accommodation, you think about how that plays out. And let's say that tens of thousands of people are not making a car payment this month, which was agreed to. But when it comes to the reporting of that, if everything goes as was agreed in the CARES Act, then there'd be no late payments.
Yeah.
And now we know that if we had tens of thousands of people making car payments, we know for sure that there would be a certain percentage of those payments that would show up as late on credit reports.
Okay.
But not now. So I'm thinking, and I'm just kind of, playing this out in my head as we go along here, that it seems like we ought to see an increase in credit scores due to these accommodations playing out, at least until people reach the edge of the cliff.
But
so we don't know where that point is yet.
I remember Mark had mentioned in previous shows about how it shows up as a memo, right? Mark, remember that?
Right. So there was an article that was titled like payment deferment or payment forbearance is the new scarlet letter, and it pointed out, and we've actually seen this in credit reports that we pull on people at Pacific Private Money. It shows up, there's a little memo section on credit reports, and it will actually say that they're participating in a deferment. So even though it doesn't impact your credit score, thanks to the CARES Act, it's something that lenders are looking at and denying applications, at least anecdotally. I don't know if there's any studies or statistics on there, but we've already heard, we've had borrowers land at our company with a loan they thought they had either approved via non-QM or other conventional or non-bank sources for a relatively, market rate refinance, only to find out that their application had been killed because they saw that the lender, that is, saw, oh, well, he skipped a payment. Boom, he's out. Are any clients coming to you, Evan, to ask you for help? Is there something you could do to fix that? Can you get those memos, so-called memo, whatever, however it shows up on the credit report, can you get those removed?
I have not. I have not seen those come through, and I don't doubt that they're out there. Generally, I'm concerned with the scores, you know, and we all know that that's only one component of approval. And lenders have many other things that they're looking at. I do see many credit reports coming through where the mortgage advisors or potential lenders' comments after the main section demand some kind of explanation.
Okay, we're going to get into that a little bit more in the next segment. Let's go ahead and cut to our first commercial break. The trivia theme is the movie Jaws. How does Quint, remember the kind of the gruff guy who gets eaten at the very end, how does he get the town's attention when he enters the town meeting? The very first time you see him is when he enters the town meeting. How does he get the attention of everybody? All right, that's our odd trivia question. Call 888-912-1190. The first caller with the correct answer wins that Tanning certificate. Stay with us. You're listening to The Best of Investing. We are going to be right back. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with Mark Honf and Nam Phan of Pacific Private Money. First trivia question on the movie Jaws. How does Quint get the town's attention when he enters the town meeting? Mark?
I'm still shocked that you did the whole spoiler thing and said he gets eaten at the end.
Oh,
I'm not going to watch it now.
That's not one of the questions.
Fingernails on the chalkboard.
Yes, very good. Fingernails on the chalkboard.
Nice.
Everyone cringes.
Nice. Yeah.
Exactly.
That's how Mark gets our attention here at the office.
Yeah. Hey, before we get back to our guest, I want to make a mention here. SeaTrek is open for rentals, trips, and classes, even with COVID policies in place. Spend a day or evening kayaking with us on the protected waters of San Francisco Bay. Professional guides can take you on a number of routes around the Bay Area. They have single and double kayaks, lightweight paddles, and comfortable life jackets. In addition, they have stand-up paddle boards, but reservations, are required. So go to seatrek.com to start your adventure. All right.
Nice commercial, right? When you're talking about Jaws.
Yes, exactly. Don't worry. You shouldn't see any big white great white.
We just don't go outside the bay.
Yeah.
Stay in the bay. Don't go outside the Golden Gate.
They have
paddleboard off of the fair lawn.
See, when you have a guided tour, the guide gets eaten first, so that's a good thing, right?
Oh, there you go.
Okay, so we're welcoming back our guest, Evan Palmer, who is a credit specialist. We'll call you a credit repair specialist. All right.
There you go.
Now, what other changes have you seen, and what advice do you have for the listeners to increase their credit scores?
Yeah, well, something that we are seeing is a tightening of credit. And when that happens, one of the telltale signs are credit cards that are being, shall we say, deactivated, closed out by the lender.
For the lender.
Obviously, when credit tightens, they don't want to leave a whole lot of loose ends out there. And a couple of pieces of advice that I've been giving. One is, if you've got credit cards that are sitting in your wallet that are inactive, for instance, I have 3 and I use 1 pretty much. So I have 2 as kind of reserve. Well, I went ahead and put a small charge on each one of those and then paid it off immediately. And I'm going to do that every few months just to keep them active. Because credit cards that sit around inactive for, in good times, for a couple of years, run the risk of being deactivated by the lender. When credit tightens, they could be deactivated at any point. So that's one thing that we're seeing. Another thing that we're seeing is a reduction of credit limits on credit cards. So lenders, at their discretion, can reduce or increase credit limits. And again, when credit tightens, they're going to reduce the limits. And anybody who is at the top end of that spending limit is likely to be frozen out at some point and say, you know, that's it, no more. So these are things that you have to keep in mind just to keep your options open. And that's a big part of when times get tough is how, you know, you want to keep your options open. So keep your cards active, and know that your spending limit, even if it doesn't, you know, even if you've run up a balance that approaches the limit and it doesn't get reduced, that's not good for your credit score anyway. If the credit limit comes down, it's even worse, and your score is going to suffer because of that.
Hey,
so that's
Evan,
that's a big thing.
Yeah. Quick question. So you were talking about, you know, even if you have a card with a zero balance, charge something on it. How long should you keep that balance on there before you pay it off? Do you have to go through at least one billing cycle?
I don't, no, pay it off right away. You know,
Okay.
As soon as the bill comes in, just pay the whole thing off. You just want to keep it active. That's all.
Mm-hmm.
And having a charge every few months on there and paying it off, that's activity. Yeah, I'm not suggesting that you carry a balance.
Yeah. Okay.
Evan, question about the CARES Act, which you opened up talking about last segment. Is there a sunset date on that? In other words, are we still within that window where your score shouldn't be impacted if you say, call your lender and go, you know what, I'm still struggling, they haven't let my business open, etc. I need some more, you know, payment deferment assistance. We know that was a thing back in April and May and March, but is it still active today? Can you still call your lender? And
here's the note that I have. Coverage started January 31st, so it kind of went. Obviously, it was passed later than that.
Backwards a little bit, yeah.
Backed up a little bit. And here's the note I have. It ends when the president ends the emergency declaration plus 120 days.
In other words, forever.
So at some point it's going to end, and then you add another 120 days. To my knowledge, an emergency declaration has not been ended yet. Do any of you guys have any feel for that as well?
I have not seen references to that because that's certainly a credit issue. It almost seems like that's kind of a forgotten aspect.
Yeah, so that said, everything is still in place. Now, one piece of interesting, I guess, point of interest, let's put it that way. There's no language in the CARES Act that talks about or specifies how lenders are to go about collecting that money that gets deferred on the back end. So it's up to the lender and the borrower to come to terms with that as it's happening. And I suspect that could be problematic if a borrower makes the assumption that they're going to have a certain amount of time to pay back, and the lender doesn't feel that way. The lender feels like, okay, when this is done, 100% of that money is due today. That could be a real problem.
That's going to be a problem. No, they're going to have to stretch it out over time. Hey, guys, believe it or not, cutting to another quick break here. When we come back, we're going to ask Mark and Nam how things are going with the various funds that they have and what they see in the real estate market and the lending market. Second trivia question, and again, the movie theme, Jaws, the trivia theme. How much money does Quint, another Quint question here, how many, I thought it was Quinn, but apparently it's Quint. How much money does Quint want to kill the shark? So what's the bounty he asks for killing the great white shark in Jaws?
Like $1982 or $2020?
Back in
what would he charge today?
1975 was when the movie came out. I remember being in driver's training at the time, and then we went to go from there to watch the movie. All right, That's our trivia question. 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Stay with us. Best of Investing. I'll be right back. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hoffman, Nam Fana, Pacific Private Money. Second trivia question on the movie Jaws. How much money does Quint want to kill the shark? What was his request?
$50,000?
No. $10,000.
5,000. 10,000?
$10,000.
Almost.
What a deal.
All right. Again, last mention here also for Mountain Mike's Pizza in San Rafael. They are open during the COVID situation. Great delivery, great pickup, and excellent pizza the way it ought to be. That's Mountain Mike's Pizza in San Rafael. So, Evan, before we forget, if people have credit questions for you, how do they get a hold of? How do they get a hold of you?
Yeah, give us a call at Bay Credit Restore. We're at 415-578-5706. And you can find us online at www.baycreditrestore.com.
All right, stay with us. I know we're going to come back to you with some more questions. Let's move on to Mark and Nam. Pacific Private Money, you guys are in the lending business. What are you guys seeing in the marketplace there?
So I've got 4 headlines for you in the mortgage lending market, and this is really interesting. These are all fresh headlines from this week. Number 1, most of you have all heard this before. Fed to leave interest rates where they are for the next 3 years. That was a shocker this week. They basically promised near zero federal funds rates through 2023. Interestingly enough, the stock market reacted a little bit negatively this week to that. You would think that's positive news, but again, you never really know what. Everything's always a double-edged sword, right? So that's headline number 1. Headline number 2, mortgage lending volume in 2020 is expected to break records, all-time records. So Fannie Mae, the world's largest mortgage financier, said mortgage lending this year is expected to reach an all-time high of nearly $4 trillion. Now, of that $4 trillion, how much are refinances? Because that's really what's driving this boom, is people refinancing. I refinanced twice this year already, and 2020 isn't even over yet. 2.4 trillion, so more than 60+% of that expected $4 trillion volume is in refinancing, and so that's the highest level since 2003, and more than double the level seen in 2019. That is the refinances. Headline number 3. The refinancing boom is just getting started.
Wow.
So even with refinancings driving a record 1.1 trillion originations in the second quarter alone, and testing the limits of lenders' capacities, several resources are saying that all the conditions are right for a string of even bigger mortgage refinancing quarters in the coming, fourth quarter this year, and then Qs 1 and 2 next year. I remember hearing and reading that even though rates are now below 3%, the best rates you can get on a 30-year refi now are about 2.86 as of last week. That's expected possibly to even drop even further in quarters 1 and 2 next year. So with everything going on even with everything going on in the broader economy, this article says we're still seeing record levels of refinancing out there simply because rates continue to decline. That's headline number 3. The refi boom is just getting started. Here's number 4, which I find very interesting related to the other 3. It hasn't been this hard to get a mortgage in years.
Wow. Oh.
Which seems a little bit, it doesn't seem to make a lot of sense, but you have to understand there's 2 things sitting behind that headline.
Okay.
And this article actually only talked about one. It said mortgage credit in August was the tightest in more than 6 years as a weak economy prompted lenders to tighten their lending standards. Evan, you mentioned that earlier. So this year, lenders are tightening their lending standards. That's reason number 1. Reason number 2 is the sheer volume of refinance applications are, again, testing the limits. And in fact, some are saying rates could even be lower, but banks are purposefully not reducing rates further to discourage even more people from refinancing their loan, because you're talking about people who were at 3 1/4 and refinanced to 3, and now they're at 3 and they can refinance maybe to 2.8 1/2. Maybe if we wait a little longer, go down to 2.75.
How much do they have to like hire more people to handle the volume, and it's not worth it to them? I mean,
well, they have to, and if they don't, they can't. Now, the other thing that we know, and this is not in this article, but I know this, anecdotally, is that the length of time it takes to refinance your home loan now is getting longer and longer. It's now averaging 60 to 120 days to get a refinance processed through your bank. They're overwhelmed. Everybody I know in this market, in the conventional mortgage marketplace, is busier than they've ever been.
Well, that's good for you, though, because there are a lot of people who are going to need faster money, and that's where money comes in.
Yep. So it is, and it really is unfortunate. That part of the mortgage credit tightening is really unfortunate for people who, for example, took advantage of skip-a-pay or payment deferment. They're finding themselves left out in the cold now. In terms of the ability to take advantage of continuingly lower mortgage rates. And so, there's still a lot of uncertainty. As credit continues to tighten because of uncertainty still looming around the health of the job market, and further reduction in loan programs with low credit scores, high LTVs, and reduced documentation requirements also continue to drive the overall decline in credit availability. So again, if you're employed with a regular check and your credit's spotless, and you could show bank statements and reserves, etc., you're golden. You can go to your bank every 30 days and get a lower rate. But if you're self-employed, good luck. Oh my gosh, self-employed. In fact, a lot of lenders I talk to now aren't taking applications from self-employed borrowers because it's just too hard. The brain damage that they have to go through, they'll just wait for the next guy to come around who has a job, has a W-2 paying job, and will be easier to get approved on that refinance. So a lot of very interesting things happening, on the mortgage side of things. And again, last week we talked about how residential real estate is exceptionally strong nationwide right now, and the residential mortgage market is exceptionally strong as well. So interesting information there.
So for those self-employed borrowers, that's where non-QM comes into play, or non-agency lending. And that's been largely where many self-employed borrowers have been able to get a loan are from non-QM lenders, which we've talked about a few times on prior shows. It's a segment of lending that is growing very quickly, and one that we launched a sister company, Pacific Mortgage Capital, to address that market.
Nam, how do people get a hold of you if they need some of that non-QM funding?
Yeah, they can give us a call at 415-883-2150, or currently they can go to pacificprivatemoney.com, but we'll be launching, we'll be sharing a web address for the new non-QM lending division that we're launching.
All right, last trivia question. In the movie Jaws, what was the name of the island? Right? Where was the place? All right, stay with us. Best of Investing. I'll be right back. Welcome back to the Best of Investing. Edward Brown here, along with Mark Hanf and Nam Phan, our special guest, Evan Palmer. Third trivia question. In the movie Jaws, what was the name of the island? Nam.
Something. Amity, or
Amity.
I don't know.
That's what it was, Amity.
Amity Island.
Nice.
That's why you thought it was close to Amityville. Yeah, very good, Amity Island. So, Mark and Nam, tell us a little bit about Pacific Private Money, because you guys have more than just the one fund.
Yeah. So, we recently had a fund information session, which was actually the first one we had, where we talked about all of our funds versus, instead of, typically we talk about the Pacific Private Money Fund or Legacy Fund. And, starting with that one, it's our longest standing fund. It's been around since 2013, currently at about $60 million in assets under management. It's our primary fund and used to generally to close single-family residential purchases, some refinances. The majority of the loans are in first position. We always talk about the bridge loans that we fund, which is a large part of our loan volume, and typically those are the types of loans we're going to put in the Pacific Private Money Fund. But this year we launched 3 new funds beginning in April. We launched the Pacific Freedom Fund, which fund characteristics in terms of the types of loans we do very similar to the Pacific Private Money Fund, but the capital that we are raising in that fund, for us, it's more like a warehouse line. It's meant to grow to about 10 million this year. We're going to use it to close loans and then immediately sell them to institutional capital, which has come back in a large way. That one pays 7%, fixed 7% earnings to the investor annualized. The Pacific Private Money Fund is 7.5 to 8. In July, we launched the North Star Capital Fund. We launched that one because of the underserved construction marketplace, where there's just a lot of builders who can't get financing, and at the same time, housing in California is vastly, underdeveloped. There's just not enough. And so we've seen an opportunity to provide capital to builders, developers, and it's a growing segment. We currently have about 5 million in assets under management. Target return for the North Star Capital Fund is anywhere from 8 to 10%. And the last fund we launched in August, that's the Pacific Southwest Note Fund. That one's the first one where we're doing loans or purchasing loans outside of California. In this case, it's Texas is where we're starting out, and these are loans that are what we're buying are seller carryback notes, and these are notes that the seller has essentially made a loan to the buyer of their home, and they're oftentimes willing to sell them at a discount, and we're buying them at a discount, and the target return to investors is anywhere from 9 to 12%. The preferred return is 9%. So 4 new funds, all very unique, and it's been really interesting over the last 6 weeks having conversations with our investors. We've seen a lot of diversification with our investors across these various funds. Some like saying, hey, I want to diversify out of California. Some say I want to diversify into construction. Some say I just want liquidity, so I'm going to move some capital into the Pacific Freedom Fund because I want to be opportunistic in this marketplace, whether it's buying a home or maybe investing again in the stock market. But people want kind of idle capital, and that's what the Pacific Freedom Fund can afford them, because
we have
you can turn around.
Would you give us a deal of the week so that the audience can understand the kind of loans that you guys provide?
Yeah. So this deal of the week is actually pretty interesting. This one is not actually typical of the kinds of loans we do, because this person in Napa County, they were able to buy a house, a historic home from the city for less than $100. And what they were going to do is they actually moved the property as well. They actually lifted it up and moved it to another spot, and they needed the funds to rehab the property and also live in it. So number one, it's historic, which often is not very, you don't see that many. They got it for a steep discount, pretty much 100% off.
I would think so, yeah.
As long as you move it out of here, you can have this house, basically. And then they put it on an existing lot where there was already one story on there. So I hope it turns out looking good. But this is
how much did it cost?
This is a loan that we made, owner occupied, and it's a Victorian. I'm sure they'll do a good job. I'm sure we look at their past track record before we make a loan like this. But pretty unique, not something we see very often.
How much was how much did it cost them to move the house?
I don't know how much it cost. We made a loan for $600,000. We valued it at $900,000. So, yeah, I don't know how big of a vehicle you need for that. Lift it up. That's
how slow you got to drive, all that stuff. That must be interesting to move a house.
Yeah.
That's kind of crazy. Evan, let's get back to you for a minute. What special advice besides the part about keeping, the credit cards, a little bit active on that? Because I get notified by a credit card company that my credit score has changed, and sometimes it goes up 10 points, goes down 20 points. What kind of stuff is going on? Because I always pay my bills on time.
Yeah, it's usually because of debt utilization, how much is being charged, and then what happens is oftentimes when you see that up and down, it's just a function of what have you purchased on a credit card in the last billing cycle. And even though that you pay it off, as I pay mine off every due date, You know, I have my one primary card, and I'll give you an example. Let's just say I charge $1,000 on it in the course of a month. Groceries, gasoline, whatever. The bill comes due, I pay it off by the 23rd. No problem, no interest, we're all good. The next month I charge $800 on it. Again, bill comes, I pay the $800, I have zero balance, we're good. But what did the lender report? What did my credit card report to the credit reporting bureaus? They report the balance that's on my credit card as of the statement date, not the due date.
Gotcha.
So on the due date, my balance is zero. On the statement date, it was $1,000, and then it was $800.
$1,800.
And that can work against your score. I mean, it does work against your score. If you have a super high credit limit, it's not going to do much. But if you don't have a high credit limit, it could be all the difference in the world.
Okay, so you're talking about the debt utilization, and I knew I shouldn't have borrowed that $50 from NOM because there it went. She reported it to me.
Did NOM report it to the bureaus?
Way down.
Oh my gosh.
No, but I'm calling Edward every day. Get it back.
But I do have a piece of advice that that's new as of this whole thing, and that is that it is easier than ever to get copies of your credit reports now.
Yeah.
By going to www.annualcreditreport.com.
And that's free.
And it's free, and it always was free, but you only used to get one free report from each bureau over a 12-month period of time. As of all of this happening, and with the CARES Act, you can get a copy of your report every week.
Well, that's really good.
All the way up until April of 2021.
So those companies, we have to cut out here in about 20 seconds, but those companies that charge for credit reports, not sure how well they're going to be doing during this time.
Well, it's still far easier to get them that way because it is, it takes a little bit. I did it myself. It takes a little bit. And Equifax was still making us mail in our requests, fill out a form, and then all of a sudden that $20 a month or $30 a month doesn't seem
might be worth it. All right,
Yeah.
Stay with us. The Best of Investing will be right back with some closing comments. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Onf and Nam Phan of Pacific Private Money and Evan Palmer of Bay Credit Repair. Mark, you have an article because we have just a couple of quick minutes to go.
Yeah, this one was, I got a kick out of this one. So while at the beginning of the year, it seemed like millennials and your Gen X and Gen Z were going to finally take hold of the housing market in 2020, the pandemic drastically changed that prediction. Instead, for the first time since the Great Depression, the majority of young adults are living with their parents.
Wow.
According to this survey, 52% of young adults, that's adults between 18 and 29, are living with one or both parents as of July. And that's up from 47% at the beginning of the year. So you parents out there, we commiserate. We understand.
But again, how much of it? I mean, it's got 90% of it has to do with COVID. I got to think,
Absolutely. No, that's true.
Yeah, I mean, because I could.
Now you think the flip side of this, again, every newsworthy article has two sides to the story. The flip side is once we're back in recovering from COVID, that's just there's that many more people who might have been saving their money or lowered their expenses so that they could be in a position to be able to take advantage of the housing market. Now, of course, we didn't get too deep into the housing market, but this was a stunner. Home prices nationwide in the month of August up 11%.
Wow.
That was not expected or predicted at any point in the last couple of years. We were expecting the housing market, and it was settling down. We were accustomed to 5% year-over-year appreciation rates, and then we were predicting that it was going to both go flat, maybe 1, 2, or 3. But again, because of low-priced capital and the lack of new inventory coming on the market, home prices are getting bid up. So while unit sales are down, home prices have gone up. Now, whether or not that turns around and those home prices valuations fall again, once we see some activity on the building side and once sellers decide to sell, once we're outside of COVID restrictions, it'll be interesting. And there are some signs. Another article I saw that there's actually 4 California housing markets that are predicted to be that have already are down 5% on average year over year. And these are Bay Area cities: Redwood City, San Mateo, and Fremont, which are all bedroom communities for Silicon Valley, whose prices have gone pretty high. They're already year over year down 5% and expected maybe to drop further. So a lot of interesting things happening in residential real estate in California and throughout the nation right now.
All right, before we cut out, give out your information for people who are interested in either borrowing or investing.
Borrowing or investing, PacificPrivateMoney.com. That's our website. Go there and check us out, PacificPrivateMoney.com, or call us. We're in the 415-418-32150, 415-883-2150.
And Evan, people have questions on credit repair?
Right, we're at baycreditrestore.com, and you can reach us at 415-578-5706.
All right, here we're going to cut out. These thoughts are a little bit more on the serious side rather than the usual comic side we have. Someone helping you is not always your friend, and someone opposing you is not always your enemy. And be strong enough to stand alone, smart enough to know when you need help, and brave enough to ask for it. I thought that was pretty good. All right, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.